cost of borrowing is coming down. Financial markets are placing a greater than 90% chance of a 1/4 percentage point cut. The official cash rate has been at a 13-year high of 4.35% since November 2023. We have our business team on hand for the decision, as well as reaction from Canberra. Our political reporter Tom Crowley is in Canberra for us, and our chief business correspondent in Veranda is here in the studio with me. David Taylor joins us with his analysis from the Reserve Bank in Sydney. And indeed, David, can I start with you then? Any chance at all that the Reserve won't move today?
Well, there is a chance, and if you believe the financial markets, it's sort of anywhere between 1% and 10%. But I think the point is that a Reserve Bank interest rate cut is not guaranteed because the case to cut is not overwhelming. There is definitely a case to cut, but it's not overwhelming. And what I mean by that is that we were originally expecting the unemployment rate to go up to, say, 4.5%. That's what the Reserve Bank was forecasting, and that's what Treasury was forecasting. And it was seen that an unemployment rate that high would be enough to cool the economy so that price pressures would really start to ease. And the labour market itself is still pretty tight. The unemployment rate is around about 4%. So the big question the Reserve Bank has is an unemployment rate at 4% low enough to ensure, or I guess on the flip side, high enough to ensure that inflation doesn't accelerate from here? The other factor, of course, is that even though the trimmed mean inflation rate, that's the one that smooths out all the volatile items in the basket measured by the Bureau, even though that has come down consistently over the past few months and over a year for that matter, it's not within the Reserve Bank's target band. And we know that the trimmed mean inflation rate doesn't need to be exactly within the Reserve Bank's target band for the Reserve Bank to cut, but they need to be confident that it will eventually get there. So the big question, they've obviously made a decision already, we're just waiting for it. The big question today will be, is the board confident that inflation will eventually achieve and land in that target band with the jobs market as tight as it is, Ros?
Have there been signals from the Reserve, though, to say whether they are leaning towards an interest rate cut? I know they play their cards pretty close to their chest most of the time, but in the last statement, the end of last year, when the last rates meeting was, there seemed to be a suggestion that they were holding off, but it looked likely that we'd see something in February.
Yeah, I mean, it all comes down to the unemployment rate. So in December, when we had the Reserve Bank say that it was, gaining confidence that it would be able to cut the cash rate because inflation was returning to target, 2 days later the unemployment rate came out and it showed a tight jobs market. But then we were all waiting for that fourth quarter December CPI figure and the trimmed mean figure, and that had come down from mid 3% to just above outside the Reserve Bank's target band. It was about 3.2%. And that was crucial because it showed that those items in the basket, the ones that have been really sticky, so you look at out-of-pocket healthcare costs, you look at insurance premiums, rent, the cost of building a new home, that sticky inflation had started to, unstick a little bit. And that was when the momentum shifted all the way to great expectations today they would cut.
All right, let's go to Ian Veranda now in the studio with me. Hi, Ian. So if there is a cut then, first of all, do you think that there will be a cut?
Yeah, I think there will.
Okay.
The Reserve Bank has had plenty of time in the past few weeks since those inflation numbers dropped to hose down the speculation. They've decided not to do that. They could have given a speech to the Train Spotters Association, for instance, and said, we need to be very careful about what we're going to do in the future. Not say anything dramatic, but just put the feelers out there and just sow the seeds of doubt. They have decided not to do that. And look, those inflation figures, the December quarter inflation figures, were much lower than the Reserve Bank even anticipated back in November. So that is really the catalyst for it all.
Okay, just about 20 more seconds to go before we'll know. But if they do cut, will it be 25 basis points or possibly more? I
think it'll be 25. And even after that takes place, if it does happen, the handbrake will still be very much on the economy at the moment. It'll just be a quarter of a notch off.
So it's those December quarter inflation numbers which really, if it happens, sealed the deal. Those came in lower than expected. Where was the surprise in those figures?
Well, it's dropped from, the core inflation figure has dropped from 4% back in June.
Rates have been cut by, I believe, 25 basis points. Yes, that's right. So that official news just coming in, 25 basis point cut as expected by virtually everybody. Sorry, Ian, you were saying.
Well, back in mid-year, the core inflation figure was sitting at 4%, and the Reserve Bank in November really decided to cut it back to 3.4% as a forecast. When it was finally delivered, it came in at 3.2%. And if you take each of those quarterly figures going back, to this time last year, there's been a consistent drop in the core inflation figures and quite a sharp drop as well. So it's gathering pace. That's the thing. So if the Reserve Bank didn't cut today, they would run the risk that inflation would be going too low. And I know that there's this argument about unemployment, but the Reserve Bank has two mandates. One is to maintain full employment and the other is to keep inflation within the target band. Now, because we've got a strong jobs market, that is not a bad thing. That's actually quite a good thing. Every other indicator of the economy is weak. GDP growth just barely crawling ahead.
So, cut today. What does the future look like?
Well, you have to see what they say, but the pricing at the moment is that there'll be another 2 cuts this year. So probably one middle of the year, one later in the year.
Can we just remind ourselves what interest rates have been doing over the last little while? We have a graphic which shows the curve and the line of what's been going on. If we can bring that up, I think we have that somewhere. There we go, 10-year chart. Can you just talk us through that pandemic? Obviously very clear there.
Well, yeah, what we saw, look, for a long period of time we had inflation actually below where the Reserve Bank wanted it to be, and rather than really cut rates, they left rates, the argument is they left rates too high. This is the Reserve Bank. Now you can see that big flat line in the middle. That was that period where the Reserve Bank did nothing at all, even though inflation was barely getting to 2%. And then, of course, as the pandemic came to an end and we saw inflation when the pandemic started, we saw inflation really drop away. The Reserve Bank cut to emergency levels there and sat there, and then unfortunately they waited a little too long before they started hiking rates, and they did it at an extraordinary pace.
Okay, let's take a look at inflation then. You were speaking about the core inflation rate being at 3.2%, slightly above the target range, but it will falls in inflation will accelerate. You were saying this is the last few years of that number there. Yeah,
is that core? It's a bit hard for me to see that. That's probably the consumer price index.
Yes, it is. Yeah.
So that peaked at around about 7.8%. And so we're now down to 2.4%. So that as the CPI, and that's the official number for inflation, from 7.8 down to 2.4, the Reserve Bank wants that to be between 2 and 3. Now the reason they're focusing on core or underlying inflation is because the government decided to put some subsidies through there for rent, for energy bills in particular, and that skewed the CPI figures a little bit. And so they were focusing more on the underlying rate. But the underlying rate has been coming off at a fairly rapid clip since, particularly since the middle of last year.
So borrowers, of course, will be relieved to see this rate cut, but it doesn't mean much unless the banks pass it on, will they?
There's that, but the other thing is inflation isn't measuring the cost of living. You know, inflation, things are still going to be horribly expensive. What inflation tells you is the speed at which prices are rising. So prices are still going to remain horribly expensive. They just won't be rising as quickly as they have been in the past. And so the cost of living crisis will remain a crisis for quite some time until wages growth starts to catch up. And that's possibly not going to be until 2030.
But people should feel that they have a little more money in their pockets because they're not paying as much for every month for their mortgage. If the banks pass it on, there's no question that they will pass it on. It would be very unpopular.
I don't think there's any question they'll pass it on. Some of the banks have suggested that they're helping their clients out, those really struggling, by putting them on, interest-only loans and doing all sorts of things to avoid having people default on the loans. So I think the banks are quite mindful at the moment that they want to keep their loan books intact, and they do not want people defaulting on their loans. So they've gone out of their way to try and avoid those kind of problems. So a rate cut coming through at this point they would certainly be passing it on. You'd be unpopular, wouldn't you, as a banker, if you didn't pass it on?
And indeed, Westpac has just passed on that the rate cut from the Reserve we just heard. So you said that wages really have to go up for people to feel better. When's that going to happen? It's
already happening now. Wages have been rising, and they've been rising at a faster pace than inflation just for the last few months, I guess since the middle of last year. So it is starting to, real wages are starting to grow, but we had a huge drop in real wages during that period when inflation inflation was really gathering pace. I mean, we had inflation well above 7% and wages growth at half that. So, that puts everybody, basically that's a pay cut in real terms. And so that situation is now reversed, but it's going to take quite some time, years in fact, for us to get back to where we were.
You've got some reserve forecasts there, or economist forecasts for some of the numbers we can expect, which of course will determine what happens next with rates.
These were the forecasts that the Reserve Bank put out in November, and I mean, obviously, in terms of core inflation, they were predicting 3.4. Inflation at core came in at 3.2, and it really had, really started to come off the boil from about midway through last year. But, you look at GDP growth, and in the September quarter, it was 0.8%. Now, we're looking at the next set of numbers will be coming in fairly soon, but 0.8% growth in the economy is appalling, really, and we need to start to get the economy back up to scratch. We've got insolvencies running at record levels at the moment. We've got retail sales really just barely flatlining. So there's a lot of indicators out there that the economy is in rather poor shape. The one saving grace that we have here is that the unemployment rate is at a low level.
Well, let's just recap our breaking news this hour. Then the Reserve Bank of Australia has cut interest rates for the first time since November 2020. At its February meeting, the RBA board decided to decrease the cash rate by 0.25 of a percentage point to 4.1%. It is a reprieve for mortgage borrowers after the central bank hiked rates on 13 occasions between May 2022 and November 2023. The reduction had been widely expected after figures released last month showed inflation had slowed in the final quarter of 2024. And of course, this decision will have major implications for the upcoming federal election campaign. In just a few minutes, we'll go to our political reporter, Tom Crowley, who is in Parliament House with more, and we'll be checking in with our finance reporter, Nadia Daly, to find out what exactly this rate cut means to households. She's been going through the numbers and will join me in the studio to find out how much you can expect to save on your repayments and which banks have already committed to pass this on. But first, let's bring in Diana Messina, who's the Deputy Chief Economist with AMP and who joins us now from Melbourne. Diana, welcome. No surprises then today?
No, we've been forecasting a rate cut from the Reserve Bank for a number of months now. I would call this one a hawkish cut. And what I mean by that is basically that the Reserve Bank didn't want to give the indication that it's going to cut rates aggressively from here because it doesn't want to stoke a secondary round of upside inflation. And it basically said that in the statement. It said that even with this cut, monetary policy is still restrictive, but at the same time, there is no need to really cut monetary policy or to cut interest rates aggressively right now. So I don't think we should be expecting many rate cuts this year. We think that we'll get another two, but it's not like we're going to see back-to-back rate declines.
Okay. But how long do you think this cut will take to feed through to the economy? Because households and businesses have been under a lot of pressure, haven't they? When will people actually start to see a difference? And what's the process of that?
Well, usually it takes a few months. So the bank, if it passes it on to the mortgage holders, if you have an existing loan, that usually takes a few months to settle through your account. For business loans, it's quite similar. If you're a new borrower, then a 25 basis point reduction on average sort of earnings and on an average loan means that you can probably borrow about $9,000 or $10,000 more with an additional 25 basis point rate cut. And on an average mortgage size in Australia of about $660,000, this rate cut will save you about $100 a month. So if we kind of calculate the rate cut that we've had, the tax cut that we had from the 1st of July last year, and the improvement to purchasing power through the drop in inflation and wages running above that, now the average household is about $80 a week better off now relative to a year ago.
Okay, so inflation is coming down. Ian was making the point that doesn't mean that prices are getting cheaper. It just means that they aren't rising as quickly as they had been.
I mean, that's of prices is really important here. So if we think about the rate of inflation over the past 4 years, inflation's gone up by 21% in the last 4 years and wages have gone up by about 15%. So there is this gap between people's take-home pay that they're feeling, which is why we are still getting households who are struggling with cost of living challenges. But the situation right now for the average consumer is much better than where it was a year ago.
So the US government and Donald Trump threatening new tariffs on many countries. Australia could be included in that. How challenging could that be? Potentially how inflationary could that be?
Well, the good news is that Australia only exports about 4% to the US as a share of our total goods exports. And the tariffs that have been announced so far have been quite targeted to just a few industries. So even if we get all of our exports to the US impacted by tariffs, it's only worth about 0.9% of our GDP. Now, that's really important to keep into context. It does affect those sectors, those export sectors that are targeted from the tariffs, but from a macroeconomic point of view, the impact to consumers is quite small. The more important impact to Australia is via the trade channels and the indirect impact that we may get from China. If Chinese growth starts to slow because of high tariffs that are imposed there, that may slow down our commodity exports to China. But from a consumer inflation point of view, right here, right now, the tariffs that have been announced will have a negligible impact to consumers in Australia. Different story for those in the US, though.
Yeah. So the Governor of the Reserve Bank, Michelle Bullock, is due to deliver her usual media conference in just under an hour's time now. What would you like to hear from her? What questions would you have about the move today?
It would be good to see where the Reserve Bank thinks that interest rates need to settle or will settle in Australia. I think that that's quite important for households to consider, because we sort of know that we're not going to get interest rates going back down towards zero anytime soon like they were before the pandemic. But now, are we talking about interest rates at 2 or 3%? I mean, it will be hard for the Reserve Bank themselves to know, because the economic outlook is probably more uncertain now than it was a year ago. But having some sort of clarity as to where longer term rates are would be interesting.
Gianna Messina, very good to get your thoughts and your analysis today. Thank you.
Thanks so much.
Back to David Taylor then, who's outside the temporary site of the Reserve while the main building is renovated. So David, you've been looking over the statements from the Reserve Bank that accompanies every rates announcement. What are the highlights from it?
Ros, I can assure you though, this is a very nice building, so they're doing very, very well, I can assure you. Look, this is really interesting because the 4.35% cash rate has now turned into a 4.1% cash rate. It's still restrictive, so 4.35% is designed to slow the economy down, make sure supply is greater than demand. That gets prices down. 4.1% for the cash rate is still considered to be something that's a bit of a noose around the economy's neck. It's still designed to slow demand down. So what's really interesting about this is the Reserve Bank has said, we're prepared to tweak it a little bit. We're prepared to drop the cash rate to 4.1%, but we don't want to stall the progress of disinflation. So deflation is when prices fall. Disinflation is when price rises come down a little bit. We're going to get so squeezed at the stores. But the Reserve Bank has made it very clear it's worried about progress. The progress that it's made on disinflation over the past few months is going to peter out or be stalled. So to kind of counter that, in the statement, the Governor has said that they're going to be cautious on the outlook, which basically means they're going to be data dependent. They're going to wait for the next unemployment rate. They're going to wait for the next big quarterly CPI result, the inflation data that they get. They're going to be watching for what out-of-pocket healthcare costs are doing. They're going to be watching for insurance premiums. They're going to be watching for rent and the cost of building a new home. In other words, the war on inflation is not won yet. There's been enough progress that the Reserve Bank is confident of reducing interest rates a little bit on the expectation that the inflation rate will hit that band of between 2 and 3% by the end of this year or 2026. But they're not so confident that they can maybe do another rate cut in April or May and then another rate cut in August. So while households watching this coverage might be thinking, great, the Reserve Bank's cut rates, there's plenty more to come, that's actually not the case. It's great news for mortgage borrowers today who have received that extra, let's say $100 for a typical $750,000 mortgage. That's wonderful news. But we can't give viewers that confidence right here and now that there'll be 2 or 3 or 4 interest rate cuts this year. The Reserve Bank says there is still the risk that inflation might, the disinflation that we've had might stall, and therefore the prices that we see at the checkout won't come down by as much as we'd hoped. So I'd love to say monetary easing all the way until 2026, but we can't say that. But for millions of mortgage borrowers today is some relief, and that's welcome.
So let's see how the markets have reacted to this move. Joining us in the studio is our finance reporter, Nadia Daly. Hi, Nadia. So the markets had been expecting a cut, so how have they responded to today's news?
That's right. No surprise for markets who'd been largely expecting this cut. And as a result, we haven't seen too much movement on the Australian share market. The All Ords and the ASX 200 are down about 0.4%. They were prior to the announcement. They did fall a little in the minutes afterwards, but now they're around the same 0.4% lower. And the Australian dollar is just slightly lower as well at 63.4 US cents. So, but still early days, just a few minutes after the announcement. So this may very well evolve over the afternoon.
Yeah, and some banks have already said that they're passing on the rate cut.
Yeah, very quickly we saw the response from banks coming in. We've seen that already Westpac, CBA, NAB banks have all announced they're cutting their home loan rates by 0.25%, so passing on that rate cut, which of course they're not obliged to do, but failing to do so would probably make them quite unpopular with their customers.
Absolutely. So you've been looking at what this rate cut will actually mean to households. Can you take us through the numbers on that?
Yes, so we know there's been a rate cut, obviously good news for anyone with a mortgage, but just how much extra cash will that put in your pocket potentially? Well, for an owner-occupier on an average variable interest rate of 6.3% with a $500,000 mortgage, this cut today will bring your monthly repayments down by about $77 per month. So if you have a $750,000 mortgage, by these calculations, which are from CanStar, you'll save $115 a month on your mortgage. But it must be noted that your minimum monthly repayments may not automatically go down. Some banks won't automatically adjust the repayment. So if that's the case, it's worth reaching out to your bank and asking for them to be reduced.
Nadia, thank you. And we also need to thank our senior business correspondent Ian Verinder and our business reporter David Taylor for being with us. Well, a reminder, we will hear from RBA Governor at 3:30 Australian Eastern Daylight Time. Before that, Treasurer Jim Chalmers is scheduled to speak at 3 p.m. Eastern, and of course we'll be hearing from the Shadow Treasurer Angus Taylor too. And you can watch all of those events on the ABC News channel. Now, this decision will have major ramifications for both sides of politics as we look ahead to a federal election that'll be dominated by the cost of living crisis. So let's bring in our political reporter, Tom Crowley, now. Hi, Tom. So how will this be received by the government?
Well, hallelujah, at least that's what will be said in the corridors of the ministerial wing. You won't quite get that level of triumphalism from Treasurer Jim Chalmers at his press conference in 15 minutes, but this went to script for the government. This is the rate cut they wanted. It's now the rate cut that they've got. There might have been that note of caution from the Reserve Bank, as you've heard, that one rate cut doesn't necessarily bring two or three. But to be quite frank, for the government's political fortunes, it was really all about getting that one in the bank before they face the voters. As you heard there, it makes a big difference to people on variable mortgages in the pretty short term. I think it's if you're on an $800,000 home, you might save about $1,500 a year. That is real relief. Treasurer Jim Chalmers straight out of the gate with a media statement ahead of his press conference saying it would be very welcome news for households. He called it the relief that Australians need and deserve. Of course, he didn't go so far in the last few weeks as saying that there should be a rate cut. He wouldn't offer that free advice, but after the fact, happy to say that Australians deserved it and that Australians needed it. A pretty clear signal there of what he wanted to happen. Well, he's got his wish. There was also a line there that said this won't fix every problem in the country, but it will help. So that gives you some sense of the language that the government will use. Looking forward, it will now try to point to the fact that Australia has gotten to the point where the rate cutting cycle has begun without either a spike in unemployment or a recession. That is a pretty unusual achievement by global standards, and while we're not out of the woods yet, it is worth noting that some other central banks, which went a little higher on their interest rates, started cutting in a period of time where unemployment was going up or where they'd had quarters of negative growth. What we've seen here in Australia is that households have been taken right to the line. They haven't been saving any money. The household spending was flat in the last quarter of GDP that we saw, but they haven't really gone backwards. The government will hope that it can use that to turn a positive case and present a positive case now to the voters, saying, look, it's been a tough 2 or 3 years, but it's been a tough 2 or 3 years everywhere in the world. We can now show you this tangible sign of progress that things are turning the corner. On the other hand, as you heard from Ian a few minutes ago, just because inflation's coming to heel doesn't mean those prices are coming down again, or indeed that they will ever come down. It's that different price level that we think is really part of why voters are so frustrated. Their $150 shop becomes perhaps a $175 shop. That doesn't change. That's what the coalition will be emphasising this afternoon. It's what we're sure to hear from Angus Taylor. The price of everything has gone up and won't come down again, that voters are still worse off than they were 3 years ago when you take into account both the rate hikes and the effect of inflation and what those two things have done to household disposable income. That is where the economic debate in federal parliament has been for some time. It's been in this holding pattern. I feel like we've been talking for 12 months about when this rate cut's going to come. This doesn't fundamentally change the nature of it, but it does move us into the next conversation, into the question about when the second and third rate cuts will come, exactly what this phase looks like. And there's a sign also from the Reserve Bank that there are different risks coming into view. We did see, and so we've also got the more detailed statement of monetary policy that's come out from the Reserve Bank. I've had just a little skim in the last few minutes while I've been sitting here. They are still worried about some of those upside risks to things like the labour market. What if unemployment? What if the labour market is too tight, and that means that inflation is not sustainably back within the band? That might mean that we'll see the rate hold for a little longer. But they're starting to talk about some other risks as well. In particular, they've done some interesting modelling on the effect of Donald Trump's potential tariffs, what that might mean for China, the world economy, and by extension Australia. What they've reported in this statement of monetary policy is that some sort of trade shock would be likely to have a negative effect on Australian output, a modest, fairly small 0.2 percentage points, I think is the figure that I read in their main scenario for what the Trump trade tariffs over the long run or over the next year or so might mean for the Australian economy. But they also noted that the uncertainty might make people warier about spending. If those things weigh down on economic activity, that would underline the case for further rate relief. And it's partly because it is focused on that uncertain international picture that the Reserve Bank thought that today was the day to go. They could see that inflation was coming down a little bit faster than perhaps it had anticipated. They're not ready to hold some sort of victory party, and you shouldn't expect that from the government either. But they did say, with a number of other risks starting to come into view, now is the time to move into a territory that is still contractionary. So 4.1 is still the level that the RBA thinks that rate is going to be constricting households, constricting the economy, but it's a little less so, and it's exactly that light at the tunnel that the government was hoping to see. They will be very relieved to see it.
So, Tom, can you talk to us a bit more about just how this rate cut will play into the upcoming election campaign and when we might get an announcement on when that election might be?
It is the eternal question, Ros, or at least it feels like it's been eternal. We've been talking about it for some time. There's been some speculation that right off the back of a rate cut, the Prime Minister might be willing to head, if not this afternoon, to see the Governor-General, maybe later this week or even this weekend. That would be consistent with an election in perhaps late March. Although there is the issue of the WA election, which comes on March 8. And it's for that reason that some others have suggested that the Prime Minister might be happy, not to look a little bit too neat, like he's running straight off the back of a rate cut, might wait another week or 2 or 3 and call an election for some time in early April instead, steering a little clear of that West Australian election. Of course, this is all guesswork at this point. We don't know, but we do know that if there hadn't been a rate cut today, that might have prompted the government to reconsider whether it wanted to go all the way to May and perhaps roll the dice on getting the rate cut in April. Now that they've got that monkey off the back and got the rate cut, I suppose the simplest thing we can say at this point is that it clears the deck for Anthony Albanese to run to the polls if that's what he wants to do. This is certainly the last shot in the arm for a government that we suspect has had its last sitting week in Parliament. When we left last week, the Prime Minister was dropping hints. He kept saying it was the last day for the House of Reps. That suggested that the budget, which has been scheduled for late March, and the sitting week that was supposed to happen around that, may not happen. But there are a few other little parliamentary things to play out, including the fact that Michelle Bullock herself is to appear before a parliamentary committee later this week. And then we head into what is always a lively week, Senate estimates the week after that. So a couple more parliamentary things to go. Interesting to see whether the Albanese government now decides it wants to do those before it runs to the polls. There was an expenditure review committee meeting in Parliament House today. The government's financial leaders coming in as they're still preparing for that budget that notionally is supposed to happen in late March. So some interesting decisions ahead now for Prime Minister Anthony Albanese. I think the truth is, Ros, no one really knows, except perhaps the PM himself, exactly when this election is going to be called. But this big shot in the arm, as I say, is there for the government now, and the option is there for them to run to the polls if they so choose.
OK. Tom, thank you. So the rate cut will come as welcome relief to households across the country, many of whom have been struggling with the high cost of living. Let's check in with Dr. Dominic Merrick, who's CEO of Financial Counselling Australia. Dominic, welcome to you. So this is what a lot of people had been hoping for.
Yeah, there will have been many people just waiting with bated breath for this announcement, and it will bring some relief to people who are mortgage holders. We're seeing mortgage holders who are under enormous amounts of financial stress and who are really just hanging in by a thread. So this will be welcome. Because of the hope that it represents, I suppose, that easier times are to come. But we are not out of the woods yet. This is the beginning, and it's a welcome sign of hope, but it will take some time before that relief is fully felt.
Been hearing just that, Dominic. It is going to take a while for the rate cut to feed through to people's pockets. So what are you going to tell your clients about how to respond to this move?
Yeah, so really the message is that while this is welcome, and we should all take that in our stride, if you are struggling right now, relief is not going to be forthcoming. So there needs to be a plan. People need to really people need to take the time to make a plan. So one of the things they can do is to hop onto the National Debt Helpline website, and that will give them a sense of what their options are and the kinds of things that are available to them if they are struggling right now.
How busy have you been with people who are getting in touch with financial counsellors, with people who can help with debt over the last few years, I guess?
Yeah, so over the last year, in 2024, we had a 12 to 13% increase in the number of calls and chats to the National Debt Helpline, and face-to-face services are reporting very high levels of demand. And what's interesting is that the people who are seeking services, it's broadening out. So we are seeing mortgage holders and people in employment, along with renters and people experiencing homelessness. So it's a broader, deeper problem that we're dealing with over the last couple of years than we did in the years before the pandemic.
When people do get in touch with you, with the National Debt Helpline, are you always able to give them constructive help? Because that's probably the thing that most people feel bad about, that they feel that there's nothing that can be done to help them. They're really backed into a corner.
Yeah, quite often there are quite a few things that can be done. And the first thing to say is having a really good understanding of what your situation is often helps. Having the advice of a friendly ear with professional expertise who can run people through what their options are and what's available to them, and to put a plan in place. What we hear from clients is that often that makes a world of difference.
All right, Dr. Dominic Merrick, very good to get your thoughts, and thank you for being with us this afternoon.
Thanks for having me.
Let's recap our breaking news this afternoon. The Reserve Bank has cut interest rates for the first time since November 2020, taking the cash rate to 4.1%. And we've been getting reactions from members of the public to the Reserve Bank's decision to cut rates. Let's hear some of those now.
That's a huge change for us. That's going to make a big difference. Not for my aunt who's visiting from America, but we have a mortgage, so I have to check my bank statements to see how it works, but that's really good news.
Pretty good for a first home buyer, so yeah.
It's got cut down to 0.25%.
Yeah.
Well, yeah, it's good for people that want to buy, and it's good for people that want to pay. So,
what are your thoughts?
On the interest rates coming down?
Yep.
Very good. Very good. Tell Mr. Trump he needs to do the same.
Let's take you through who we're expecting to hear from in the next hour or so. Treasurer Jim Chalmers is expected to get up in the next few minutes, and shortly after that we're expecting to hear from the Shadow Treasurer Angus Taylor. And we'll get more analysis with our Chief Business Correspondent Ian Verrinder and more political reaction from Canberra, of course. And then, of course, RBA Governor Michelle Bullock is going to be speaking at 3:30 Australian Eastern Daylight Time. So you should stay with us here on the ABC News channel. If you want to head online, though, you can go to abc.net.au. You can use our mortgage repayment calculator to find out how much you can expect to save on your home loan after rates have come down today to 4.1%.
Hello, I'm Gemma Vaness. This is ABC News coming to you from the land of the Darug people. Now, we are standing by to bring you a news conference with the Treasurer Jim Chalmers, and this follows the Reserve Bank's decision to cut interest rates by 0.25 percentage points today. Now, this move today, it's the first cut from the RBA since November 2020. The decision is, of course, a reprieve for mortgage borrowers. Many of them have endured the 13 rate hikes between May 2022 and November 2023. Also reprieve for would-be home buyers. Now, let's take you live now to Canberra with the Treasurer about to speak on this.
Okay. Everyone good? Okay. Well, today the Independent Reserve Bank decided to cut the cash rate to 4.1%. This is very welcome news for millions of Australians. This is the rate relief that Australians need and deserve. Now, we know that it won't fix every challenge we have in our economy or in household budgets, but it will help. It's a demonstration of the progress that Australians have made together in this fight against inflation. Now, that progress that we've made has been substantial. It is now sustained, and it's reflected in the decision taken by the Reserve Bank today. Now, when we came to office, inflation and interest rates were rising. Now both are falling. Now, other countries have had to pay for that kind of progress on inflation with much higher unemployment, negative quarters of growth, or even recessions. And Australia has managed to do better than that. Under this Labor government, inflation is down, wages are up, unemployment is low, and now interest rates are falling as well. This is the soft landing that we have been planning for and preparing for, but we can't be complacent about the months and years ahead. We know that there is more work to do. We know that this is not the solution to every challenge that people are confronting in their household budgets, but it will help. It is a welcome step when it comes to providing a bit of relief for Australians are doing it tough. Now, for a household with a mortgage of $500,000, the rate cut will save them $80 a month or $960 per year. Now, if you look at the statement made by the Reserve Bank Board today, it makes three things very clear. Firstly, inflation has fallen substantially since the peak in 2022. Secondly, the inflationary pressures in our economy are easing faster than expected. And thirdly, the board has more confidence that inflation is moving sustainably towards the midpoint of the 2 to 3% target range. And because of those three developments, that gave the Reserve Bank Board the confidence to make the decision that they have made today. Now, inflation is now almost a third of the 6.1% that we inherited, and that is a reflection of that progress on inflation that the Reserve Bank Board has referenced in their press release today. Now, today's decision and the statement from the board gives us more confidence that the worst of the inflation challenge is behind us, but we're not complacent about that either. Today's decision is very welcome, but it's not mission accomplished because we know that people are still under pressure, and that's why the primary focus of this Albanese Labor government will continue to be the cost of living. It was before this decision, and it will be after this decision as well. Now, before I take your questions, I wanted to let you know that this afternoon, after the decision was made public, I spoke to the CEOs of all four major banks Each of them have made an announcement that each of the major banks will be passing on in full the benefits of the decision taken by the Independent Reserve Bank today. I don't take credit for those decisions that they have made and announced already. In each case, they were already well progressed in their planning, but I wanted to say that I consider that a very good thing, that each of the four major banks has already indicated that the benefits of this rate cut will be passed on in full. Happy to take some questions. I'll start with David, then behind you, then Ben, then Phil.
Treasurer, you mentioned a couple of things the RBA said. It also said the central forecast for underlying inflation has been revised up a little over 2026. So in that longer term outlook, or in that outlook over the next year or two, it doesn't look better. Is that on you because you're not doing more to bring down that pressure on inflation?
Well, I'd make three quick points about that. I mean, first of all, they've revised down their forecast in the near term. Secondly, the further out you go, the more uncertain that forecast is. And thirdly, what we've seen in recent data releases is that inflation has come in lower than anticipated by the Reserve Bank. That's part of the reason why they acknowledge in their own press release that inflation is easing a bit quicker than expected. So I know that there's been some changes to the forecasts. The main point that I would direct you to in those changes to the forecast is the lowering of the forecasts at the front end of the forecast period. It's a bit more uncertain after that. I think I said I would go here, and then Ben, and then Phil, and then I'll come back.
Thank you, Treasurer. Given this decision by the Reserve Bank today, can we expect an election sooner? And will your March 25 budget still go ahead?
Well, we've been in the Cabinet suite next door for most of today and most of yesterday, preparing for and planning for a budget on the 25th of March. That's certainly what we are working towards. We acknowledge that the timing of the election is a matter for the Prime Minister in consultation with his senior colleagues, but we're certainly working towards that budget. That's why the ERC met for about 4 or 5 hours yesterday and another 3 or 4 hours this morning. Ben.
True, the RBA statement of monetary policy makes it pretty clear that they still see the outlook of certain growth as quite low. I mean, does that gel with your outlook, and will you be sort of holding your fire in terms of more stimulatory measures after this?
Well, we do share the Reserve Bank's concern about the uncertain global outlook. You know, I've expressed that to you and in other forums for some time now. The world is an uncertain place, and we see that reflected in the Reserve Bank's statement today. And growth in our economy has been soft. People have been under very substantial pressure and continue to be under pressure. And this decision today is partly a reflection of those two things, but it's mostly a reflection of the very substantial and now sustained progress that we've made together on inflation. Phil, and then I'll go back.
You're quite cautious about declaring mission accomplished on the cost of living. But nonetheless, this is the end of a succession of rate increases. Are you prepared to tell people that it will get better from here?
Well, first of all, rates stopped rising in November of 2023. So it's been almost a year and a half now since rates have gone up. We've had that long period where rates were steady. I wouldn't go near any of that sort of language. You know, I think it's clear from the inflation data and the decision taken today that the worst of the inflation challenge is behind us, but we're not complacent about that. I've been saying that for some time as well. You think about that inflation peak in 2022, 6.1% and rising at the election, got to 7.8 by the end of the year, now at 2.4, underlying inflation in the low threes on both measures, doing much better than was expected by around this time. And so certainly when it comes to the inflation challenge particularly, the worst of the inflation challenge is now a couple of years behind us, but we have to stay vigilant. We can't be complacent. You won't hear any kind of anything other than recognition from us that people are still under pressure. And this rate cut will help a little bit, but we know that those pressures on household budgets are still there. That's why our cost of living help is so important. We'll come back here to Anna, then we go Self, then James.
Treasurer, we've been speaking to people on the streets. They say this is just part of the puzzle for them. They're still desperate for other immediate cost of living help. We committed in the budget to have new cost of living measures to help them.
Well, first of all, our focus is on rolling out the very responsible but very substantial cost of living help that we've already budgeted for. tax cuts, energy bill relief, cheaper early childhood education, cheaper medicines, fee-free TAFE, rent assistance, getting wages moving again. These are all rolling out in our economy right now. It's why we saw in the most recent national accounts that recovery in disposable incomes, particularly when it comes to the intersection between lowering inflation, rising wages and the tax cuts so that people are earning more and keeping more of what they earn. As I've said to you and to others in this room and elsewhere over a long period of time, from budget to budget, we see what we can responsibly do to help people with the cost of living. That's been a feature of the first 3 budgets, and if we can afford it, it will be a feature of the 4th.
Treasurer, obviously the decision on the election date is firmly with the Prime Minister, but surely this interest rate decision, that must give you confidence about Labor's election chances. And just on a separate issue as well, we just had a fact check about your claims that Australian households will be $7,200 worse off under the coalition. The fact check said that the calculations were flawed because they weren't adjusted for inflation and that the assumption about the pace of wage growth was unrealistic. So how can Australians believe those claims that you put forward about Australians being worse off?
Well, the figures that we provided were a contrast between the wages growth we saw under our predecessors and the wages growth that we're seeing now, combined with the energy bill relief and the tax cuts that Peter Dutton was so angry about he called for an election over. So Peter Dutton has opposed our cost of living help, and the record of the coalition in office was much lower wages, not accidentally, but as a deliberate design feature of their economic policy. And so we are well within our rights to point out that the biggest risk to household budgets in 2025 would be a coalition government led by Peter Dutton. Australians would be thousands of dollars worse off if he had his way on wages and tax and energy bill relief. And they'll be worse off still if he wins, because when he was the Health Minister, he came after Medicare. They've come after wages before. His nuclear reactors would push up electricity prices, and so we are well within our rights to point that out. Now, where your question began was around the politics of what's happened today, and I have been very careful and deliberately so in not applying a political lens to the decision taken by the Independent Reserve Bank today. Today's decision was about economics, not politics. The only senior person who's tried to inject a political lens to this or a political angle to this was Peter Dutton was last week making the case for higher interest rates, and that's for him to explain. James?
Treasurer, if I may, to follow or to take you back to David's question, in the statement today the bank notes that there is a number of upside risks that remain to the economy, particularly the tightness of the labour market. Do you agree with the RBA that the labour market may need to soften to see inflation fall further? And secondly, if I may, a sort of a broader question, do you believe that budgets deliver governments a bounce, an economic bounce, a political bounce in the polls these days?
Well, on the first part of your question, I've got the same view now that I've had for some time, which is what makes the Australian experience exceptional is that we've been able to see a very substantial moderation in inflation at the same time as we've maintained the gains that we made in the labour market. That's been deliberate too, remembering that the Reserve Bank has a dual mandate, full employment and price stability. And you know that this government has a particular focus on the labour market because that is one of the most important people-facing parts of the economy. And what we've shown over time and seen over time is that we've been able to keep unemployment very low at the same time as inflation's come down and wages have come up. And that's the trifecta that we have been seeking. On the other part of your question, I mean, that's a matter for political scientists and commentators like yourselves, respectfully. My job is to obsess over the numbers in the economy, not the numbers in the published opinion polls, and that will continue to be my approach. Well, just to pose some order here, we're going to go Claire, then Katina, then Ron, and then we'll come to the front.
Treasurer, the end of the electricity bill subsidy in July obviously has an impact on forecasts around headline inflation. Has the government come to a decision on whether they're prepared to extend that, and will Australians know before the election what's happening with that?
First of all, we treat the withdrawal of the energy bill rebates the same way the Reserve Bank does, and it's forecast, and it's as you described it in your question. That is a reason for one of the drivers of the inflation forecast that the bank has released today. We'll release our own forecasts in due course. When it comes to additional cost of living help, whether it's energy bill rebates or others, as I've said, I think in response to the questions over on this side, we keep that under constant review. You know, if there's a case for affordable, responsible cost of living help, then we will do it. We've done that in the first 3 budgets. We've found a way to make that consistent with cleaning up the mess that we inherited in the budget itself. So if there are other ways we can do that in a responsible, meaningful way, affordable way, then we will consider that between now and the budget. Katina, and then Ron, then Michelle, and then David, and that will probably do us.
Treasurer, how big of a risk is a tit-for-tat tariffs, a global trade war, in pushing up inflation here down the track? And also just on the Virgin and Qatar deal, it seems like they need further approval perhaps before June. Can you give them some guarantees that that will happen before caretaker mode comes in?
Yeah. So on the first part of your question, I think it's a really good development that the Reserve Bank has given you a sense of its thinking on the impact of trade tensions, escalating trade tensions around the world. They use different scenarios than what we did, but the conclusions are broadly consistent, which is that there's 2 kinds of impacts: direct versus the broader impacts on China and the US, the big economies, and how that would flow through to Australia. So I suspect Governor Bullock will have a chance to speak to some of their thinking when she's up shortly, but I think it's a good thing that they're helping Australians understand the potential impacts. On Virgin Qatar, I am yet to receive the advice from the Foreign Investment Review Board. I would be very, very surprised if I couldn't make a decision on that before the election. Ron, and then Michelle, and then David.
Thanks, Treasurer. With inflationary impacts that come from overseas factors like trade wars and various other things, do you think that any upward pressure on inflation from this point created by those is best dealt with by monetary policy, or does government policy, fiscal policy have a role to play as well?
Look, I think whenever there's global uncertainty, or indeed any kinds of shocks in the economy, the best approach is when the 2 parts of economic policy work together, and they have been. It's a point that Governor Bullock has made before about our 2 surpluses being helpful in the fight against inflation, recognising that public spending's not the main game, but we can be helpful. And so anticipating some future shock from some kind of global event, I think I would say what I've said before about that, which is both the Reserve Bank and the government have got the same objectives: grow the economy, keep inflation low, maintain full employment, but we've got different responsibilities. And one of the reasons I've been so careful not to apply a political lens to the decision taken today or in the lead up to the decision taken today is because I recognise the independent role that the bank's got to play and the role that the government has to play, different responsibilities but the same objectives, and that's why we have been focused on our job, not theirs. Michelle, then David.
Given the intensity of the election campaigning by both sides now, do you think that there is a risk for business in delaying the poll until the very last moment, because a lot of decisions are sort of put on hold in a pre-election time?
I don't believe in any significant way that to be the case, because we know that there's an election due in the next 3 months. We know, observing history, that typically people put their hands in their pockets around election time to wait to see what the outcome is. But we're not talking about an election in 6 or 9 or 12 months' time. You know, regardless of the decision the Prime Minister takes, an election is more or less imminent. And it's not a surprising timetable because we are more or less full term now. So there's always an element of that. I don't think there's an extra element of it this time round. David?
Treasurer, as you mentioned, we'll hear more from the Reserve Bank Governor shortly, expanding perhaps on the geopolitical uncertainty that she's pointed to in the statement.
Yeah.
That'll be her thinking. What's your thinking, though? Does what Donald Trump is threatening on the trade front pose a risk to the global economy and the Australian economy?
Well, I think we've made it clear for some time that there's a lot of global economic uncertainty. We've seen that more or less as a permanent feature of the last, well, really 15 years or so. And now, when it comes to those concerns, they're focused on the risks of escalating trade tensions. And we've been monitoring those risks very closely. We did a heap of work before the change of administration in the US, as you know. Because when you look around the world, there's the risk of escalating trade tensions. There's still a major land war in Eastern Europe. There's a tentative ceasefire in the Middle East. There's been pretty serious political upheaval in places like Korea, to some extent France. And so the global economy is a pretty uncertain and pretty dangerous place right now. We have made that clear in our own commentary on the situation, and the Reserve Bank Governor has as well in the statement that she has released. These are things that we monitor very closely. The risk is higher inflation and lower growth around the world at a time when growth has not been especially thick on the ground and where inflation has been a feature of the last 2 or 3 years. And so obviously we take that very seriously, as does the Reserve Bank, judging by the statement that they released today. Thanks very much, everyone. Appreciate it.
Okay, that was the Treasurer Jim Chalmers speaking after the Reserve Bank's decision to cut the official rate for the first time since 2020. Now, the major banks will be passing this on in full. Now, Jim Chalmers said there that this is the cut that Australians need and deserve, and that cost of living will still be front and centre for the Albanese Labor government. Now, as we know, this cut, it's been a long time coming for borrowers and would-be buyers. It's also been a long time coming for the Albanese government. It's some good news for them to report after enduring a period of rate hikes during their term of government. And of course, there are political implications here as to the timing and tone of the upcoming election. We have afternoon briefing host Patricia Karvelis to be taking us through what this cut will mean on those fronts. Now, the RBA Governor, Michelle Bullock, will step up at the half-hour mark to speak about this decision. Economists view the RBA's decision as a sign that Australia's central bankers believe that inflation is being tamed, but we will, of course, be paying close attention to what she has to say on this today. Now, let's bring in our Chief Business Correspondent, Ian Verrinder, now. Ian, this was widely expected. What does it mean for mortgage holders and buyers?
Well, Gemma, clearly it means that people will be able to borrow more money to buy houses, and the danger there, I guess, is that it may fuel price rises again in the property market, which is something that the Reserve Bank would be keen to not happen because, I mean, housing prices are pretty unaffordable in Australia at the moment, and that's one thing that they would be very keen to do. The biggest transmission, and the one that the Reserve Bank would be hoping for, and the government as well, would be that people do get a little bit more money in their pocket, and that may end up, back in the economy, propelling growth just a tiny bit, and trying to fix that gap that we've had between basically real wages going backwards, and the cost of living crisis that's been really draining Australian households of money.
Okay, well, we will take our viewers now to the Shadow Treasurer Angus Taylor, who is speaking after this decision.
Long-suffering Australian borrowers, small businesses, bigger businesses, families, of course, who have been suffering under heightened interest rates and core inflation, which has been well above target for a sustained period of time. It has been a long time coming. It has been a long time coming. We've seen interest rate cuts in peer countries around the world of between 1% and 2% in countries including Canada, the US, Europe, New Zealand, and Australians have been suffering in the meantime with high interest rates. And in the course of the last 2.5 years or so, since interest rates have been rising, a typical Australian household has paid an extra $50,000 in interest rates than they had expected to pay. And that has been a huge impost, of course, on Australian families who have been doing it very, very tough. Now, despite the welcome cut today, it's a long journey back to the standard of living Australians had when these interest rate increases began. We've seen 12 interest rate increases under Labor and one down now, but we've also seen the biggest collapse in living standards in our history. It has been completely unprecedented. It's also been unparalleled relative to other peer countries around the world. The living standard collapse in Australia has been bigger than peer countries around the world. And indeed, in the forecast today from the Reserve Bank, there is a downgrade in living standard forecasts. Despite the interest rate cut, the Reserve Bank is expecting that living standards will be worse than in their previous forecasts, and this is more pain for Australian families. The journey is far from over here. The journey is far from over. Now, let me make a critical point about how we've got to where we are. Australian families have done the hard work here, and they deserve this interest rate increase because they're the ones that have done the work. To get interest rates down, demand has to come into balance with supply, and we've seen rapid growth in public demand, rapid growth in government spending, but indeed we've seen households tightening their belts. Households have had to tighten their belts because governments haven't tightened their belts. And the fact of the matter is households have had to do the work, and we see this every day. We see it in the living standard outcomes that I described a little earlier. Now, Labor's own forecasts don't get us back to the living standards that they inherited back when they won the election in 2022. They don't get us back to those living standards until 2030. With further downgrades today, it's a long way back to where Australians were when Labor came to power. And we know that the critical issue now for government is to accelerate that pathway back, accelerate the pathway to restoration of Australian standard of living that they had when the interest rate increases began. That means beating inflation once and for all, sustainably beating inflation. It means making sure government does tighten its belt, that it grows spending at a manageable rate, not at the rapid rate we've seen in recent times. 36,000 additional Canberra-based bureaucrats. That is not how you sustainably beat inflation. It does mean boosting growth and making sure there isn't red tape being wrapped around small businesses who are trying to invest and create jobs, take risks, all the things that businesses have to do to create opportunities for themselves and for all Australians. It does mean making sure we've got cheaper, more affordable energy for all Australians, getting the underlying cost of energy down in this country. And it does mean, of course, making sure that there are affordable homes for Australians, breaking those infrastructure bottlenecks as we've outlined with our $5 billion fund to make sure those critical bottlenecks that are holding back the supply of housing are fixed and we get that supply really moving. We have had a very, very tough 2.5 years for Australian families. Australian families are poorer than they were 2.5 years ago. We cannot afford another 3 years like we've seen over the term of this parliament. Happy to take questions.
You say that Labor's predictions show that they won't restore living standards until 2030. How soon do you think the coalition government will be able to do it?
Well, we've got to accelerate it. No, that was my point. That means beating inflation sustainably. And as I pointed out, you don't do that by having rapid growth in government spending. Indeed, government as a percent of the economy at record levels across state and federal governments. I mean, that's not how you sustainably beat inflation. And in fact, Australian households have had to do the work to get demand and supply into balance because governments haven't done their work. So you've got to get those things right. You've got to make sure you boost growth. And that means getting red tape out of the way, letting businesses get on and do what they have to do to invest. Investment drives productivity and it drives prosperity. But we're not seeing enough of that. We're not getting the approvals through under this government. I mean, this is getting the basics right, making sure small businesses have got the cash flow so they can invest. And that means making sure our tax regime is incenting and encouraging small businesses to make those investments. This is getting the basics right. We know we can accelerate it, and that is the task of government. This government we have right now has taken Australians backwards. We need to accelerate the journey back to where they were.
What specific cost of living measures are you offering Australian households?
Sustainably lower inflation and lower interest rates than they would otherwise have had, accelerating the pathway back to the standard of living that they enjoyed before Labor came to power. It's pretty basic stuff. Look, let's be clear about economic management here. Labor doesn't know how to manage the economy, and if you want to beat a cost of living crisis, the key is economic management. You cannot beat a cost of living crisis if you can't manage the economy, and that's exactly what we've seen under Labor. 7 consecutive quarters of GDP per capita going backwards. That is not good economic management.
Voters, though, will be looking at what's on the table for them. They might hear this rhetoric and think, yes, we like the idea of that, but it's a broader picture. What tangibles are you offering them in terms of...
Well, I've got to say, if you're suggesting for a second, I'm not saying you are, but if you're suggesting that sustainably lower inflation and lower interest rates...
OK, we're going to leave the Shadow Treasurer Angus Taylor there and take you live to a news conference with the Reserve Bank Governor Michelle Bullock following the RBA's decision to cut interest rates.
As you know, the board decided today to cut the cash rate by 25 basis points to 4.1%. The cash rate has been at 4.35% since November 2023. At that time, in November 23, the upside risks to inflation had increased. So the board decided to raise the cash rate to 4.35% from 4.1% to address those upside risks. Since then, inflation has fallen and recent data suggests it's eased a bit more than expected. Growth in private demand has also been quite weak and wage pressures have eased. The board therefore judged that it was appropriate to remove the cautionary raise undertaken in 2023. I've said many times that we need to see inflation moving sustainably towards our 2 to 3% target band before we ease rates. In December, we said we'd gained confidence that things were headed in the right direction. Now we're at a point where underlying inflation is at 3.2% and headline inflation is 2.4%. Inflation has eased over the past 3 quarters and in the most recent quarter a bit more than our forecasts had anticipated. This has increased our confidence further. It's clear that higher interest rates have been working as anticipated, restricting economic activity and putting downward pressure on inflation. The board judges it's time to reduce a little bit of that restrictiveness, but we cannot declare victory on inflation just yet. It is not good enough for inflation to be back in the target range temporarily. The board needs to be confident that it is returning to the target range sustainably. One of the big questions we're grappling with now that inflation is easing is how the labour market is reacting. The board's strategy has been to bring inflation down while preserving the gains in the labour market. The judgment was that we could achieve this with a gradual easing in the labour market. But the strength of the jobs market has been surprising. Many indicators suggest that the labour market is tight and on some measures tightening further. While this is good news for job seekers, the board remains alert to the possibility that it is signalling a bit more strength in the economy, which could delay or stall the disinflation process. There's also a lot of uncertainty around the global outlook at the moment. One of the things we're cautious about is the possibility that policy unpredictability could lead to slower growth. But at the moment, it's too soon to tell. For these reasons, I want to be very clear that today's decision does not imply that further rate cuts along the lines suggested by the market are coming. As I noted, we've removed the cautionary increase that we did in November 23 to a level that we still see as restrictive. But the board needs more data and evidence that inflation is continuing to decline before making decisions about the future path of interest rates. The board is very alert to upside risks that could derail the deflationary process. I know that some other central banks have cut interest rates quite sharply over the past year, but we have taken a different strategy to most. Our policy rate was not raised as much as many countries overseas. We judged that while inflation expectations remained anchored, we could take a bit longer to bring inflation back to the target band, but we could keep unemployment lower. We can be happy with the progress we've made, but we have to be careful not to get ahead of ourselves. The truth is that some inflation pressures remain, and cost of living pressures are still front of mind for many Australians. The board is conscious that households with mortgages have had to adjust following interest rate increases since the pandemic. And the impact of high inflation over the past couple of years has permanently increased the price of goods and services. That's hurt everyone, but particularly those on lower incomes and the more vulnerable. The board will continue to look to the data to see if the economy and inflation continue to evolve as expected. Happy to take your questions.
Governor, Deb Knight from 9 Radio and A Current Affair. There are some very relieved Australians today with the rate cut and the banks behaving out of character, falling over themselves to pass on this rate cut in full. How line ball was the decision, though? The markets were certain it was a done deal, but how difficult was this decision today?
It wasn't a lay-down misère, Deborah. It was a difficult decision in the sense that there were arguments on both sides. And what I would say is that the board had a very active debate of the arguments on both sides on this, but in the end came to the view that the better decision was to ease a little bit of the restrictiveness, still maintain some restrictiveness, but ease a little bit of restrictiveness in recognition that we are making progress towards our goal. I understand that many households will be relieved with this, but the important point that I've made before is that it's really important we beat inflation because that hurts absolutely everyone.
Hello, Governor. David Chow from ABC News. So what are the chances the Reserve Bank is one and done when it comes to interest rate cuts? And today's cut could be the only one that we see.
Thanks, David. I couldn't say. What I would say is that the market is expecting quite a few more interest rate cuts till the middle of next year, about 3 more on top of this. Whether or not that eventuates is going to depend very much on the data. Our feeling at the moment is that that is far too confident that that's as many rate cuts as we'll be having. So I can't say one and done. What I can say is that we've done one, we've removed a bit of restrictiveness, we are still restrictive, and we are waiting for more evidence that we're getting inflation sustainably back in the band before we are willing to move again.
Governor Bullock, Jack Quayle from The Australian here. The RBA seems to be an outlier when it comes to estimating full employment. Granted your forecasts, can the economy sustain unemployment at 4.25% to hold inflation within the RBA's 2 to 3% target band?
It's a good question, Jack, and there's a lot of debate out there in the market about what level of unemployment or employment is consistent with low and stable inflation. I have to say at the moment we're a little surprised because we have seen inflation continuing to come down at the same time as we judge the labour market is still a bit tight. But there are things that are happening. We see housing costs are starting to decline, which is good, and that's a big part of people's expenses. We also hear from Liaison and other areas surveys that business margins are being squeezed a bit, which suggests that demand is not strong enough for them to pass on these things. So these are sort of, we don't know the full answers yet. And as I said, I've said in the past, I think, what that level of employment is actually really uncertain. So we're not pinning our numbers on it. I'm certainly not pinning any number on what that unemployment rate is. But we are continuing to test how low we can keep unemployment without adding to inflationary pressures. And so far, in good news, we're achieving it, but there are risks. We've got to be careful.
Michael Reid from the Australian Financial Review. Governor Bullock, could you give us some extra detail about what conditions would need to be in place for the board to be ready to deliver a second rate cut?
Well, the sorts of things that the board is worried about at the moment in terms of the upside risks would need to abate a bit. So we'd need to continue to see easing wage costs, growth in wages. We'd need to continue to see that. We'd need to continue to see the disinflation in market services in particular. We'd want to see that the reduction in housing inflation we've seen is sustainable and it's continuing to come down, because that's been a very big component of the rise in inflation over the last couple of years. And I think also what we'd need to see is a general easing. We don't know what the demand-supply gap is here. We're very uncertain about it. And I think we've set out in the statement on monetary policy that in the past we've thought demand was a bit above supply, but we're a bit uncertain now whether that's still the case. So it'd be really good to see some recovery in supply, on the supply side of the economy, and obviously productivity is an important part of that as well. So they're not an exclusive list of things that the board would need to see, but all of these things, if you started to see these things, these would be good for inflation, and that's what we're looking for.
Governor, Effie Zahos, 9 News. You just mentioned that the cost of living pressures are still there, and you mentioned that some prices are permanently higher. Do you acknowledge that this rate cut barely touches the sides for households?
It's a very small rate cut, that's true. It reverses the one we did in November. But I think we are removing a little bit of restrictiveness. It has an impact at the margin for people who have mortgages. And again, the fact that inflation is coming down is actually really good for everyone. So that's really positive for renters as well and people on low incomes. So yes, it's at the margin, it's a small decrease. The banks have passed it on. Every little bit helps.
Governor Swati from Bloomberg News. The RBA was doing a live experiment in monetary policy by not taking interest rates very high. Do you think you have been successful given what we have seen in New Zealand and in some other economies as well? Do you think the RBA's experiment has been successful?
Might be a bit early to say, Swati, I think. We are getting more confident that we're being successful. We're not the only country. The other country that has a dual mandate, of course, is the United States, inflation and unemployment. And when you listen to them, you'd know that they often talk about unemployment as well. So we're not the only country that's been thinking about the impact on employment of our monetary policy. I think it's too early to say whether we've been successful, but as I said, I think the signs so far are positive. We have got inflation coming down. We've got in our forecast, you will see from the Statement on Monetary Policy, we have the trimmed mean being back in the band in the first half of next year, and that's on the basis of the current market path of interest rate cuts, so it's got that little qualification in it. But have we not been tight enough and inflation will take off again? I think that remains to be seen, and it is a risk that the board is alert to.
G'day, Governor. Shane Wright from 9 Newspapers. The Statement of Monetary Policy talks about growth improving and strengthening, but for the next 2 years, effectively, it's around 2.2 to 2.3. Trend for Australia is supposedly around 2 3/4. Do you think trend growth has actually stepped down, and why?
Well, part of the issue is productivity, I think. Remember that productivity, we've got some assessment in there for productivity, or assumptions for productivity, I probably should say. But we all know that productivity hasn't been as strong as we would have hoped. And that's the way we grow the economy. That's the way that we can have trend growth higher, because if demand increases and supply doesn't, then that's when you get inflationary pressures. So I think there is some question about how do we grow the supply capacity of the economy, which increases the trend growth of the economy, and that does come down to the sorts of things that we should be doing about productivity.
Sophia Rodriguez from Central Bank Intel. You said the rate hike in November you've reversed the rate hike from November 23. Given there were upside risks even after that, if you had to raise the cash rate once more, do you think we would have been in a more comfortable position, and probably 2 more rate cuts you could have been confident of at this stage?
Well, no, because if the board thought it needed to rise rates further, it would have. So the board thought that in November 23 it raised the rate to offset some upside risks, and if it had thought it needed to go further, it would have, but it didn't. It felt that the best way to achieve its strategy of bringing inflation down and keeping employment as strong as we could was to keep rates where they were for an extended period, which we did. We kept them there from November 23 until now. So I think now is the right time to unwind that increase. We're still restrictive. We still think we're in restrictive territory, and that will continue to keep a bit of pressure on inflation.
Thanks, Governor. Hi, John Keogh from the Australian Financial Review. The forecasts have inflation sort of flatlining at 2.7% through to 2027. I think the official target is 2.5. That's what the RBA review recommended. Is that still your goal, or is less than 3% good enough, given that your cutting rates are not actually expecting to hit the 2.5% target?
So, John, as you would know, that 2.7% is actually predicated on a market path which sees 3 more cuts. So what that tells you is that if we really want to hit 2.5, which we do, and I'll come back to that, then that market path, on the basis of the information we have at the moment, is unrealistic. Have we abandoned 2.5? No, we haven't, because our target is 2 to 3%. And the best way to make sure we stay there is to target the middle of the band. If we target the top of the band or the bottom of the band, then the likelihood we flop outside the band increases. So it's really, I think it is important that we target the middle of the band. We're not always going to hit bang on the number, but it gives us the best chance of staying within the band that we can.
Governor Edward Boyd at Sky News. Just to follow up to Swati's question, the narrow path has been a bit of an experiment. If it does turn out to be a success, do you think it could become a blueprint or a new strategy for other central bankers around the world to follow in the future?
Every central bank has a focus on inflation, but they all have slightly different mandates. We have a dual mandate. We have employment, as does the Fed. Other countries don't necessarily have that. So it depends. It's not necessarily a strategy for all central banks. Central banks will decide based on their own legislative mandates how the best way to achieve their mandate is, and it's not the same for everyone.
Cécile Lefort from the Financial Review. Governor.
Cécile.
Policy, you say, is restrictive, but some economic indicators like housing lending suggest policy is not restrictive. So how tight do you think policy is, and what level do you estimate the policy not restrictive?
So I wouldn't like to hazard a guess as to what specific interest rate we would think is. You might be referring to the neutral rate. It's a very uncertain concept. Housing credit is probably a bit more restricted than you think it is because it's in nominal terms. And if you look at housing credit, I'm pretty sure we had something on this in the statement. Housing credit as a share of nominal household disposable income isn't actually growing very much at all. So remember that it's a nominal concept and it's relative to household disposable income, which is more important. So, but having said that, there are some things that on the business side, if you look at our dashboard of all the things we look at in terms of financial conditions, on businesses they seem to be a little bit better. Risk premiums are quite low, the equity market's high. On the household side though, we know, and this goes back to an earlier question, that households are paying record historical amounts on their mortgages in terms of payments, required repayments, as a share of their income. So it is still binding and very tight on the household sector. And this has been one factor, not the only factor, but it's been one factor that's been important in the response of consumption. We haven't had growth in real incomes, real household disposable incomes, and that's been a product of a number of factors, including interest rates. So we know it's restrictive on the household side, less restrictive on the business side. We still would think that overall conditions are restrictive.
G'day, Governor. Jacob Stayman from the Australian Associated Press. What conditions would trigger the board to raise interest rates again?
Well, if inflation reversed course and we started to see the signs that we were seeing easing inflation start to move in the other direction. I mean, that is ultimately what we are aiming at. Now, what we've observed from overseas, and we've observed it a bit here as well, is it can be bumpy. It is not a smooth ride. And so we're going to be getting some more information on inflation in the next few months. It'll include some monthly indicators, which can be very volatile. It will include some quarterly numbers. What we'll be looking for is continued disinflation in those. If that starts to reverse course in a trend sense and we start to see some of the easing in prices we've observed start going back up again, then that is going to be something the board would seriously need to consider.
He stole my question. I was going to ask that because Warren Hogan has been one of the people that's been very critical, saying you'll lose credibility if you do cut today. So with that in mind and just on the back, what other factors, particularly from offshore with these tariff threats as well, could force your hand to raise rates?
So the tariff threats and what's going on overseas, it's very uncertain and probably even worse, it's unpredictable. So we don't know exactly what's going to happen, so we can't sort of make specific plans. What we probably can say is that in a particularly bad case, it would be bad for economic activity around the world. and possibly China, and that wouldn't be good for us. What it means for inflation is slightly different because it could mean higher inflation in some countries due to tariffs. So it very much depends on how it plays out in terms of, well, what actually gets implemented and then how people respond to those things. But I think we are thinking about it in the longer term. We're trying to not focus on the noise. We're trying to think, well, what sort of things might impact activity and impact us, and what might the impacts be on inflation. So that's sort of the things we're thinking about, but we really don't know yet. It's still a movable feast.
Governor David Taylor, ABC. A lot of this stuff goes over people's heads, and there are a lot of people listening and watching right now that just, they're very pleased that they just got a rate cut and all four banks have moved. But I get the sense that millions of mortgage borrowers, because you're the public face of this, right? And they want hope from you. And you can't give forward guidance, but outside of forward guidance, in really plain speak, can you give millions of households some hope now, the households that are really struggling to make ends meet, in terms of their mortgage repayments?
I can't tell them what will happen, but the point is we have made one cut, and at the margin, I understand that will be helpful for some people. But I want to come back to the point I was emphasising earlier, and we focus a lot on mortgage holders, and yes, they are hurting because interest rates have risen so much from the emergency lows during the pandemic. But the fact that prices have gone up by 18% over the last couple of years is hurting them. It's hurting all of the renters, it's hurting all the low-income people, it's hurting everyone. So it's really essential we get that under control. And that will mean that we can return to more normal levels of interest rates. I don't know what they are, but what I can say is that they won't be the levels of interest rates they were during the pandemic. They were emergency low interest rates. They will be above that. How much below where they are now, I couldn't tell you, and it will all depend on the success in getting inflation down.
Nick Files from the Financial Times. I just wondered, now you have cut in an election year, are you concerned about further cost of living relief measures or promises, and whether you factor them into your forecasts for the coming year?
So what we factor into our forecasts is what's publicly known about public expenditure. And as you will have seen in the statement on monetary policy today, we see, with the assumption of the cash rate target, we see inflation declining to within the band, but not quite back to the 2.5%. So I have no further knowledge of what might happen in terms of cost of living relief and so on. Cost of living relief, I should point out, is really helpful for households because it does help the financial pressures they're under. So it's important, but it does mean that sometimes reading the inflation numbers are a little bit more difficult, makes them more volatile. So we can't guess what they might do. All we can do is take what is given to us and use our instrument, which is the interest rate, to best meet our target, which is the inflation rate.
Jennifer Duke from Capital Brief. I'm going to extend on from that question. Clearly, economists all seem to think that there's a big surge in spending coming over the election campaigns on both sides of the aisle. Did that give you any reason to pause today and yesterday during the board meeting? And do you have any thoughts on whether those things could be inflationary down the track?
The board basically considered what it knows at the moment. It doesn't speculate on what governments might do. Politics does not enter the conversation. It's purely based on the data and what we know at the moment. If that changes, then we have other meetings to consider what changes.
Hi, Governor. Stella Cho from Reuters. So with inflation slowing, don't you need to keep cuttings to stop real interest rates from rising? And if you don't cut in April, does it mean policy will be more restrictive by then? Thank you.
Inflation, the forecast for inflation at the moment is that well, we've got headline and we've got underlying. I think underlying is a better measure of the pulse. Real interest rates are about expectations of inflation. They're not actual inflation. And we know that inflation expectations at the moment are pretty anchored at around about 2.5%. So it's not mechanical in that way that you've described it.
Governor Michael Pascoe, Michael West Media. This time last year, the statement said it is possible we are at full employment, but it's not probable. 12 months of roughly 4% unemployment, 12 months of falling inflation. Now the statement says it's possible the bank got it wrong. It doesn't actually use the word wrong. Underestimated capacity, and yet it's sticking with the estimates. How many months does it take before the bank will admit it's wrong and perhaps accept that full employment is 4%?
Well, full employment is a very nebulous concept. I don't think you can put a number on it like a lot of people try to do. What I would say is that we are, at the moment, pleasantly surprised by the fact that we've got unemployment still at 4% and what looks like a strong labour market at the same time as we've got inflation falling. There are some factors that are playing into that. As we said, we're seeing housing costs start to decline. We're seeing margins constrained. Now, there is a question about whether or not the strong labour market, in fact, helps consumption to rebound along with the rebound in real incomes, and that stalls some of this compression in margins perhaps that's occurring and keeping inflation a bit lower. So I think the jury's still out, Michael. I think, but we are, as you would note, we are alert to the fact that the full employment could be much higher and still have a relatively sustainable low inflation rate than we've currently got in our sort of thinking. But again, we look at all sorts of things in the labour market. We don't just look at one number, and I want to really impress that upon people. It's not just one number. We've got record participation rates. We've got underemployment coming down as well. We've got lots of job vacancies. So, you know, these are all things that are telling us the labour market is really healthy. And if it turns out that we can continue with that and get the inflation rate continue to come down, that's a great thing. I'm not begrudging that at all. That would be great.
Hi, Governor. Millie Morrow from the Sydney Morning Herald and The Age. The government's been claiming a fair bit of credit for getting inflation down back towards the target. How much of the fall in inflation do you actually think is due to government policy and their decisions?
Look, monetary policy and fiscal policy are two different arms. They both work independently. The government has their role to play and we have our role to play. It's not just interest rates. There's been a number of things happening with inflation coming down. One is that supply chain pressures have eased, so there's been some of the supply side has eased, and that's allowed prices to come down. I'd say the impact on demand of interest rates has clearly been there as well. I think we are succeeding in the mix of policies that we have got to bring inflation back down at the same time as we're maintaining employment. So I think that's actually a really positive outcome. It's two arms of policy, independent, but they're each doing their own thing.
Hi, it's Kevin from Newswire. Just a quick question. Phil Lowe once said that he was getting hundreds of letters from mortgage payers who are struggling with their mortgages. Are you receiving anything similar? And if so, what's your message to these Australians?
Yes, I do receive similar messages, and my message has been in the past and continues to be, I understand that you are hurting and I understand that mortgage rates have increased a lot and you are finding that hitting your disposable income, but we need to get inflation down because that's the other thing that's really hurting you. And if we don't get inflation down, then interest rates won't come down and you'll be stuck with inflation and high interest rates. So we have to be patient. I understand it hurts, but it's really important that we get inflation down.
Governor Michael Yarnder from ABC News. To what extent do you think interest rates and monetary policy have been responsible for the massive run-up in house prices in Australia over the past 3 decades? And are you at all concerned that today's rate cut might spark the next leg up in that house price boom?
Wow, that's a historical question, Michael. We've done a little bit of work on this. I mean, household debt in Australia has risen a lot over 3 decades, and there's been a number of factors that have gone into that. One is that inflation has come down, so interest rates have come down, so serviceability has gone up, so that's been really important. The second thing is that we deregulated the banking system, so people were credit constrained, they couldn't get access to credit, so that was really important as well. So you don't like credit constraints normally, so it's a good thing they're off. The bottom line, though, on housing prices is it's the interaction of supply and demand. So we can talk about an historical sort of run-up in housing prices, and if you compare it to household disposable income, it's risen substantially as well. But this is the interaction of supply and demand. So we can't just talk about interest rates, lower inflation, lowering interest rates, increasing serviceability to add to demand, because at the same time we've had a long-standing problem with supply of housing in Australia. And we've talked about this at previous press conferences, but really the gist of the housing price problem comes down to a mismatch between supply and demand. That's what it comes down to. So
Viewers on ABC TV are leaving us. You can keep watching this live event with the Reserve Bank Governor over on the ABC News channel.
5 basis points makes a huge difference to the serviceability for people in these circumstances. So we're focused on inflation, not housing prices. If you want to fix housing prices, you've got to go to different policies.
Michelle Jonathan Shapiro from the Financial Review. You mentioned earlier that even with the market projection of interest rates, the inflation rate still won't be returned to the midpoint, to your target midpoint. And then you said that those market projections seemed overly optimistic. I guess in that context, why have you decided today to cut interest rates?
Because we have seen good progress in inflation and we're getting a little more confident that we're going to be back sustainably in the band. I've also said that we don't have to be back in the band before we start cutting interest rates. We're around about where we are relative to our target in terms of inflation is around about where other countries were when they started cutting interest rates. So I think there's some sense in which we're not out of whack there, which is good. I think also that, and I remember I made this point before, we're removing some restriction. We put on some extra restriction in November 23, and a lot of people thought that was overdoing it. Some people didn't, but other people did. We've taken that off now. We still think we're restrictive, and if we're still in restrictive territory, that's still exerting downward pressure on the economy and on inflation. So I think it's... The other point I would make is that and we've made this point a number of times, is we didn't go as high as other countries, so they've cut quite quickly. We can still possibly cut, but we may not have quite as much room to go because we didn't go as high in the first place. So we can cut because we've been restrictive, we're still restrictive, and it's a recognition that we've got some good progress in inflation, and monetary policy works with lags, and we want to make sure, if we can, that we don't miss the turning point.
Hi, Governor. It's Frances from Bloomberg. Can you please explain why the GDP growth is so weak through to 2027, and why are we not seeing a 3% or higher growth rate? Well,
the consumption is recovering, but it's not recovering as strongly as initially as we'd thought it would, and we still have it recovering reasonably slowly into the next. And that's a big driver of GDP growth. So I think it's really on the basis that consumers still are we're still in restrictive territory with consumption. We've still got interest rates in restrictive territory, so that's still bearing down on consumption. It is going to recover as real incomes recover, but it's not going to be. We don't think it's going to be a massive increase in the growth rate in consumption. It will recover, but it's not going to be a big driver of a massive increase.
Governor Michael Heath from Bloomberg, just inspired by the Australian Financial Review, so asking again. Just wanted to telescope ahead a bit to next month's meeting, when obviously the system will change and potentially we'll have votes. Was today's decision unanimous, and did you argue for a rate cut?
I think the board would allow me to say yes, that it was consensus. It was a consensus.
Governor John Rolfe from the Daily Telegraph and Herald Sun. Early on you said that 3 more cuts by the middle of next year was far too confident. I think later on you said unrealistic. Financial markets heading into today had 1 cut priced in by July. Is that also unrealistic?
Everyone always wants forward guidance. I don't want to say it's unrealistic, and I don't want to say it's realistic, is the bottom line. I don't know. We've just cut for the first time. We want to see more information on particularly inflation and the labour market before we decide what we do next. We do think we are restrictive, but as I said earlier, we didn't go as high as other countries, so we're probably not as restrictive as some other countries have been. So we are trying to balance here. It's the narrow path. I haven't mentioned that term yet, but there you go, the narrow path. And I just think as you get further out, the forecast just gets so uncertain. And I think my point would probably be that the market's probably got more confidence than I do that that path is what path is going to deliver us sustainably back to the middle of the band. I don't have that confidence yet. The market clearly has some confidence in it, but I don't.
Hi, Governor. Tom Richardson from Livewire Markets. You've updated your forecasts for trim to mean inflation to fall to 2.7% in the June 2025 quarter. I think you touched on that earlier. And for that to remain at that 2.7% level right through to June 2027. So if we assume those forecasts are on the money, is it fair to say you must feel optimistic about the Australian economy today?
Well, I think we do feel optimistic, but we're also alert to the risks. So the point is that with those forecasts, it does come back to 2.7. They're very uncertain as we go further out. But if it eventuated like that, which it probably won't, but if it did, that's not getting us back to the middle of the band. And as I said earlier, we do want to aim at the middle of the band because that gives us the best chance of staying within the target range. So that's still the aim. The point really was that the current market path that gets us there only gets us to 2.7. So that makes us alert to the risk that if we cut too much and too soon, then we mightn't get back to the middle of the band. That's how I would describe that.
Thanks, Governor. Jonathan Barrett at Guardian Australia. You said the decision wasn't a lay-down misère. What was the strongest argument against it, and how much credence do you give to that argument personally?
Some of the stronger arguments were that based on the labour market, basically, uncertainty about the labour market. We have a view that the labour market is tight and also that it has tightened recently. So one of the stronger arguments, I think, on the side of not doing anything was caution. Let's wait for more data to see what is exactly happening to the labour market. Is that feeding through to wages pressure, and is it feeding through to inflation? So that would be a more of an extended hold. So that probably is the strongest argument. And I think when you hear us talking about it in the statement on monetary policy, or read us talking about it, you'll see that the labour market does feature quite prominently there. It is something that came up a lot. We did talk about, to Michael's question earlier, we did talk about the fact that it doesn't seem to align with what we might have expected to happen. So we are continuing to challenge ourselves on that, and we're continuing to engage with others outside this organisation who have quite different views than us, because I think that it is worth really checking ourselves on this and making sure that we really are certain that we have a good idea of how tight the labour market is and what the implications of that might be. If we can have a tight labour market but it doesn't, for some reason, feed through to inflation and wages, then that's positive. That's the million-dollar question. Thank you.
Thank you. Thank you.
Well,